there's no other way to say it. Like, I just wake up. I really feel like if you can find something that you remove the money, you still want to do it, that's probably your why.
Welcome to the Cash Flow Chronicles. I'm your host, Jonny and the founder of Cattani Capital Group. For the last 2 years, I've been studying alternative assets and now help solve the problem of creating passive cash flow for creators, influencers, and busy professionals by bringing you 5 episodes a week of easy to understand education in the world of passive investing. What's up, guys? Welcome to another episode of the Cash Flow Chronicles. I'm your host, Jonny, and I'm joined today by Colm McEvilly. Colm's involvement in real estate development goes back to childhood. The son of a mechanical plumbing contractor, he spent his early years sorting fittings, excavating, and learning to read blueprints. He went on to receive a bachelor's degree in engineering from Cal Poly, and then began a career in the HVAC industry. 2013, began investing in single-family rentals in Sacramento, California. Then at age 30, suffered a heart valve failure. After a successful TAVR procedure and recovery, his entire perspective changed, and he realized he needed to spend his days doing personally fulfilling work. Colm, welcome to the show.
Heck yeah. Thanks for having me on. And before we pressed record, we talked about something that we didn't really have a topic scheduled for today, but then we were talking about the struggles that we're both finding with our investor bases, how they're not really informed in a way to have a good decision. And I said, hey, I'm doing a presentation later this week on that topic. Why don't we talk about it? So, but Jonathan, I think that you have some really interesting investments that help with creating the kind of the lifestyle you want. And that's what I'm shooting for, but just in a different type of asset class. But let me just hop in on a little background on myself, share my screen.
Yeah, please do.
Okay. So
this will be a unique one, as like Colm said, he's giving a presentation, in-person presentation in the Bay Area later this week. So he's put together a slideshow. So if you are able, this of course is on YouTube. So if you want to jump onto YouTube and watch, but of course you'll be able to also understand what's happening just through the audio. So without further ado, take it away.
So this conversation stems from the fact of investors don't really have the information collected that they need in order to make a prudent investment decision. And as we build trust with an investor, it's sometimes difficult. And the first thing that I always recommend other syndicators or capital raisers to do is help them create a decision-making process around their needs. So this is not investing advice. This is not financial advice. Every investor's situation and your situation is unique and specific. Perfect example is you might not need to do a 1031 because you have enough passive losses to offset some of the taxes that you'd be subject to. So make sure that you consult your team before investing. Here's a little background about myself. I used to work with Viking Capital and Grow Capitus. While I was there, I was on a team. I was instrumental in helping scale their investor relations department. And I just recently split from Viking. It was a very healthy split with the encouragement of their CEO, Vikram Raya. And I created TGA Investment Partners. And Jonathan talked about the fact that, I had a heart failure. Well, TGA was the issue that I was born with. And so Investment Partners is based around the fact that I want a long-term relationship with these investors. And so here's some of my syndication experience, background on myself. This is really why you should maybe consider listening to me. I'm not special. I just have a lot of exposure. I'm no smarter than anybody else. I just show up, I do the work, and I try to focus on adding value to the investors in every phone call. That's what this is going to allow you to do. So here's the caution. Make sure that you know your individual situation. If you have more questions, reach out to me. I might not be an expert in the particular thing you're looking for, but I can surely connect you to the thought leader in that industry.
Love it.
So every investor has biases, and there's a couple different types of biases. And when you go into an investor phone call, or if you are an investor, you need to be cognizant of this. The first thing is the decision bias, where you're making all of your decisions based on the information you have. So if you're interfacing with an investor, your goal is to find out where they're getting their information. If you're an investor, think about where you're getting your information. And, Fox and CNN, they have their own agendas. Well, the place where you're getting your information has their own agenda, right? So the first thing you have to be cognizant is that every decision is a bet, and that a lot of people are making a decision based on information that they didn't really validate. So your highest level goal as an investor is to make a decision that's prudent based on validated assumptions. And every decision is a bet. And another thing that you have to consider with investors is that there's results biases. So that's when people are making a decision on the quality of their decision based on the result and not actually the process at which they went to getting to that decision. So a perfect example, I'm gonna give two examples. The first one is the NFL final, or my Super Bowl, sorry. The Super Bowl where Pete Carroll
Yeah, I
called
think
out,
I've heard of that.
yeah, the NFL final, the Super Bowl where Pete Carroll did a 1-yard pass and it was intercepted by Malcolm Butler, rather than handing it off to the best running back in the NFL at the time, Marshawn Lynch. And the Seahawks, they lost the Super Bowl because of that interception. And people said, Pete Carroll, you're an absolute ding dong. Why would you do that? You gave up an opportunity for an interception. But from a statistical standpoint, there was 0 interceptions for a 1-yard throw that entire season. And so had that been a touchdown, people would have crowned him as this genius. Everybody's expecting the run, but he did the throw.
Yep.
And so that's one example where result biases happened. Another example is when investors invest without vetting the information, without getting the underwriting, without looking at the CoStar report. And there's times where you get to a level of comfort with the sponsor where you don't need that information because you trust them and you know that their strategies are aligned and they're protecting their reputation and all that. They're not going to make a bad investment. But most times when you talk to an investor and you say, hey, what's your investing experience? How has that been like? And they'll talk about a win and how that was a great decision. But really, was it a great decision because of the result? Or was it a great decision because they recognized that the strategy on the property would allow for this opportunity for a great NOI increase?
I love that. That's a really, really awesome point. And not a lot of discussion around that specific point right there, right? A lot of people, and listen, like we said, right? Ultimately, it's up to you to make the decision. If you want to blindly invest, I know people do it, and that's totally fine. Of course, once you've vetted a sponsor and like you mentioned, you feel comfortable with them, it's very common for a sponsor to then roll out an investment and you just automatically commit and you're in. But what we're trying to get at is that part comes after you've gone through this process.
100%. And we're going to talk about the process. If you have questions, you can reach out to Jonathan or I, and I could send you the process. But people think they made a good decision based on the return of their investment. And those things they're mutually exclusive. Your decision to go into an investment and the result of the investment are totally separated, because you're not even for a passive investment, you're not even in doing the daily operations. So just understand the results should not be the validation of if it's a good or bad decision. The last thing for a particular type of bias that's involved with investing is confirmation bias. So, I mean, this is super prevalent around 2020, the next election cycle. People are watching YouTube videos and content that basically confirms what they already can think or really want to hear. Right. And so when it comes to investing, you have to be aware that when you're working with investors or you're an investor yourself, really, you need to be the devil's advocate on all the information that you're getting, because some people have motives. And so understanding, maybe you could speak to this, Jonathan, but so they're interpreting new information as a confirmation of their existing belief. I'm trying to think of an example where
it's very common in how you Google something, right? Like, is crypto fraudulent? Well, if you search is crypto fraudulent, you think you're going to find some articles and some blogs that from some guy who invested in FTX and lost all his money, right? So what he's saying is you can find either side of the coin depending on how you're searching, what you're searching, where you're searching. So be cautious of the source. Do they have a bias toward one way or the other, right? It's important to know both sides of the coin, right? That's why good operators and good, investor advocates like Colm will give you both sides. Hey, this is why this is a really good investment, but here's also the risk associated with it, right? And that allows you to make an informed decision rather than just like, hey, here's the return. You're going to make, 8%, you're going to get an 8% preferred return and we're going to 2x your money in 3 to 5 years. It's like, okay, well, great. But what's the other side of that?
I'm glad you brought that up because that reminded me of an example where I was talking to a fellow and he goes, "Oh, your returns are crap." I was like, "Well, what do you mean?" He goes, "I only invest in things that have a projected 35% IRR." So I'm talking to him and he said, "Okay, because your numbers are low, it's a bad investment." And then I find out that the only other investments he's ever done is sale lease buybacks to industrial cannabis facilities. And I talked to him and he goes, he's had like 3 home run investments, but then he's had 2 where he's lost 100% of his money. And so he was confirming that my deal was bad based on a projected return, but that was absent of the risk component of the deal.
Yep.
So just be aware that people are getting information and they're trying to confirm whether it's a referral that they got from somebody else or their past investing experience. Really important for you to understand your hero's journey, and your investor is the hero.
Totally. And if it is a referral, certainly, that can mitigate some of the initial vetting process, right? If it comes from a source that you trust, that's, if someone's been successful with an operator in their last 2 investments and they're like, hey, I've really enjoyed them. They've, they take good care of their investors and they're very communicative and blah, blah, blah. And they check a lot of the boxes. Well, yeah, I mean, that's a really good start, but, don't let that be the only reason that you invest.
Yeah. It's funny too, because I had this investor, he's invested 8 times, $500,000 each time. And I was having a call with him because he makes a lot of probably 3-4 million net. And I said, hey, Mr. Investor, what's your investment criteria? How do you make a decision? Do you like a particular IRR or is there a particular hold pattern that you like? And he goes, what's IRR? I was like, oh my God. And I said, well, okay, well, I assume that because you have a lot of liquidity, there's a lot of people calling and trying to get your investment money. Why did you invest with us? He's like, because I like you and you made me money. I was like, all right.
Yeah. So sometimes that's all it takes for people.
Yeah. It's like, I like you. He said, I like you. I trust you. And you made me money in the past. That's literally what he said. So, so thinking about this, I highly recommend, there's episode 245 on cash flow connections with Hunter Thompson. He has an interview with Annie Duke, and this was a few years ago. And so just check out these books, Thinking in Bets by Annie Duke, How to Decide. And when you're going through it, think about how you as an individual investor make a decision and how your investors will make a decision. And then also more books, more help. Hands-off investor. I think this is kind of like the Bible for syndications. This is so absolutely applicable. And if you can recommend this book to your investors, I think they will help them out.
Absolutely.
And if they're a techie, if they're a numbers person, I recommend this one. It's a quick read. I actually read this on a 3-hour flight from Texas to NorCal. And it's like 110 pages. And it really highlights how people can play with the numbers within an underwriting and either mislead you or be very conservative.
Yeah. And one thing I'll say, we have a lot of first-time investor listeners, right? And so the Hands-Off Investor, great book for the first-time investor. Once you start looking at deals and kind of getting an idea of what kind of deal criteria you have for yourself when it comes to investing, specifically here in real estate, the definitive guide to underwriting is a great next step, because then you can determine, okay, how did they get to that IRR, right? Was it through manipulation, or was it via, conservative underwriting, and this is actually a really good deal? I don't expect everyone to like dig deep into underwriting like how I do. But it's good to understand at least the concept of it, and understand how, once you're seeing a deal, how those numbers were derived. And it's an easy read. He explains everything well enough where, even if you're not a numbers or finance person, you can understand each section pretty easily.
Yeah, I'm trying to look for it on my bookshelf, and it like I said, 110, 115 pages. But the key thing that he highlights is different types of sensitivity analysis.
Yep.
With the cap rates and with the lease up periods. One of the things I actually never really considered before reading this book was the lease up periods sensitivity analysis. And I was looking at a deal in Tampa, and it was 44 units, and he said he was going to rehab 12 units a month. And I was like, that's not, you gotta kick everybody out. Like, that's not feasible, man.
Yeah.
And that actually really impacts the returns on the income, because the strategy was to basically bump the income up after they do the rehab, but that wasn't a feasible real number. And so this book highlights that you should look at the different periods and lengths that it takes to actually get the rehabs done, because that's going to impact the returns, because it impacts the rent bump time. So
yeah, totally. I mean, that's a 30% that you're carrying a 30% vacancy rate through rehab. That's that will absolutely change.
That deal was extremely aggressive, and he got year one projections actually, but I don't know if he got year two. I haven't talked to him about year two, but that was the first deal where I got pretty worried about.
That's a good indication of sometimes when the market can carry you through. And sometimes that's okay, right? If you're in a good market and you know that, and you're willing to take that risk, and you understand that risk both on the operator side and on the investor side, that's okay, right? It's okay to do speculative deals as long as you understand the risk you're taking.
And that's where the sensitivity analysis will help. So
totally.
So now you understand some of the decision biases that these investors have, and it's your job as an investor advocate to build a relationship, to create trust, to help them create a process. And 90% of your investors will not have a process, maybe 10%. And I bet you they're a software engineer. Yeah, I get the most questions from software engineers, and I welcome them. And
dude, I'm only laughing because I literally went to this. So the NBA All-Star was just here in Salt Lake, right?
Yeah, you got some good pictures, man. I like that jazz jacket you were wearing.
Oh, thanks, man. Yeah, shout out to Big Brother, Big Sister. They were a corporate sponsor, and I'm a mentor, and my mentee was selected to go. So we got to go. It was really sweet. But part of the weekend thing they did was they did a big investor pitch day on Saturday, where all these investors were gathered, and it was basically a bunch of tech companies. And I was like one of the only real estate people there. But of course, I meet this guy. He's a programmer for like this company's building a crypto exchange. And when I tell you the most due diligence I've ever gotten by someone who's not even going to be an investor, like, that's why I was laughing at what you said, because that's what he is. He's a software engineer. And he was like, what? He's like, of the percentage of people that are moving here, how many of them are single? And I'm like, oh my gosh, I couldn't tell you that, like the most. And he's like, yeah, this is why I struggle with investments, because my due diligence process is so in depth. And I'm like, dude, there's nothing wrong with that.
Heck yeah. That avoids investor remorse. And actually, in one of the books that we recommend is a 72 questions to ask a sponsor, and that's in the Brian Burke book. And if you have questions, you could read. If you want it, you could reach out to Jonathan or I. We could share it.
Absolutely.
So now you know their biases, and it's important for you to help them create a process. You want to avoid the no's and the maybes. Really, you want to avoid the no's, because they either don't have the money, or they're trying to be nice to you. Or you can help them with realizing that, hey, you are going to be comfortable with a particular type of investment. So let's create that. And the benefits is it's going to save headaches. It's going to save heartaches of investor remorse. I've had investors that I've told don't invest in this project because it doesn't align with what you've told me, they still invested because they thought Austin was sexy, or they thought Phoenix was super frothy and bubbly, and they really liked it. And they would call me 6 to 8 months later and be like, man, Colm, you said I shouldn't invest. I didn't listen to you. And now, I don't feel that good about the investment. And it's like, I told you. And those deals ended up fine from a financial perspective. But one of the fellows, it was a new construction, and basically they only wanted cash flow, him and his wife. He invested in a new development that didn't have cash flow during the construction period, which was 2 years. And his wife created this law that he couldn't invest until he got cash flow from that first investment, which really stagnated his investment participation. She put a stop on that. And so he called me up to tell me that. And I said, yeah, there's no cash flow. Like, we talked about this. Right. He's like, yeah, I know. It was in Austin. I really wanted to get into it. So it's going to help put them in the driver's seat and make a decision with confidence. It's going to demystify the process, because they're going to have a very clear list of things that they're looking for that they don't like or do like. So that gives them control. And then it's going to save them time, because there's a lot of syndicators out there that are looking for investors, investment capital, and you're going to have tons of emails that are coming into your inbox, and it'll help you vet those deals more quickly. So this is the last slide, but this is the meat and potatoes of the discussion. And Jonathan and I encouraged him to just cut in whenever he has some ideas. But I put this together this morning, and the very first thing is the pre-screening process. You want to have a phone call. And if you're a syndicator, you don't want to just push them to set up a phone call, because everybody's being pushed to set up a phone call. You want to push them to set up a phone call and communicate the value of the phone call. Hey, Mr. Investor, you set up this phone call. It's going to save you a lot of time. How much do you value your time? It's going to save you a lot of headache, because we're going to get together. We're going to learn about your investing goals, where you're at, where you'd like to be. And we're going to come up with a process that's going to help you feel comfortable to move forward to a yes or a no, because moving forward isn't always a yes. It's a no as well. And then, so that the first thing is set up a phone call. And the second thing is look at the track record. We got a little doggy, hold on. The second thing is to look at the track record. That's going to be important, because it's going to tell you what type of projects they have done in the past, as well as how close their projections were to their actuals. Mm-hmm. And, a lot of people, they have the same underwriting model regardless of the deal. So it could be very conservative on one deal and not so conservative on another. Let's just say they model everything to a 15% annual rate of return. And if it meets that, great. That project might have 25% or 16%. That's what I mean is look and see how they're actually producing, how they're actually performing on those deals, because that's going to validate their approach and their underwriting process.
Absolutely. If it's their 20th time doing this exact same style of deal, you can feel really confident that their underwriting is solid, their pro forma is solid, and that they'll perform and hit their projections, if not do better, right? But if all of a sudden, they've only done multifamily, and now all of a sudden they're in the industrial space and they've never done it before, okay, well, now it's time to ask questions, why are you doing this? Are they partnering with someone who's done it before? Blah, 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 right? So those are two polarizing examples, but there can be stuff in the middle. So just pay attention, to what their track record is and how they've done in the past. And if this is what they normally do, then, you can feel pretty confident with them and kind of move on to the next step.
Perfect example is I played in the multifamily space. And I think there was a point I was maybe in 20 different syndications that were in multifamily. It's kind of like my girlfriend. I'm getting tired of it. I want to check out new asset classes, or asset types, and so I met this company at the Best Ever, and they were industrial. They're sale leaseback, triple net sale leaseback company, Mag Capital Partners. Shout out to Mag, Drew. But anyway, so I wasn't a particular expert on industrial, but I called actually a few of their investors, and I went to some of their investment events, and then I wanted to play in that space, but their track record was they had 22 full cycle investments in that
Wow.
particular space, and so I felt really comfortable because they were consistently getting a number that was acceptable for me, and so that was that track record that allowed me to jump into a new space with a little bit more comfort with a new company, and actually that particular project has 18% preferred returns. It's like crushing it. Yeah, it's doing really good. But so that builds on my next topic. Is before I invested, I went to some of their investment meetups in person, and I talked to their current investors.
Mm-hmm.
So referrals are really good because they help clarify the experience. What's the communication for the investors? Do they feel like they could pick up the phone and call the sponsor directly? Maybe you can't, but maybe you can't call the principal, but you should be able to talk to somebody directly. And so, because if something goes wrong, you want more communication. You don't want less.
Absolutely. Absolutely. Another good one in there is ask, you should be talking to the sponsor directly, right? Ask about a deal that went bad, because if you ask for referrals, they're just going to give you their 3 favorite investors, right, who have invested with them. But ask about a bad deal. What deal went bad? What did they do? Because if you're doing this long enough, there's going to be, I shouldn't say a bad deal, right? I don't want you to think bad deal, everybody lost money, but maybe they,
Didn't hit
their projections, right? Instead of a 1.8x return, it was a 1.2x multiple, or instead of a 16% IRR, it was only a 12% IRR, right? So ask why, what happened, what they did. Ask about their communication. How do they communicate with investors? Do they have investors who still invested with them after, right? Little things like that can really paint a good picture about how they are as a sponsor.
I have to build on that. The asking about a bad deal, that's fantastic. There was a particular deal that didn't go to plan. We still returned all the equity, all the principal to the investors. It was a 1.3 equity multiple, and it was supposed to be a 1.8. And so we didn't hit projections, but we also got their money back sooner than the project life cycle. But people would ask me, hey, what was the learning lesson? And the learning lesson for that particular investment was we're not playing with that strategy anymore. And it was a mixed use strategy. And then the second learning lesson was that we were a minority partner. So we didn't have decision-making influence at the table as much as we wanted. So the second lesson was moving forward, we would only be like the key sponsor, or the person that can actually make an asset management decision. And so just want to stress, great point, Jonathan. Ask about what was the learning lesson and what did they do moving forward.
Totally.
So the strategy aligns with the holds. And so a perfect example is there's a company out of Minneapolis. Actually, they're out of Rochester, Minnesota. And they do really long holds, and they'll just refi every couple of years, or every maybe 4 years or 5 years. They'll just refi for their investors. And so that might be a strategy that you like. Whereas
Black Swan.
Yeah.
Yeah.
How do you know about? Yeah.
I met they just hired a new director of marketing. They just brought on this girl, her name's Rachel.
Yeah.
I met her at Raise Fest back in January, and she dug into their structuring. And in fact, we're looking into potentially doing that with some deals here in Salt Lake, just because of the way the market is flowing right now and how compressed cap rates are. That structure actually makes sense for certain markets, and it's certainly not for every investor, but it's a unique structure for sure.
Let's talk. Not only is Salt Lake the top of the Milken Institute report on best cities in the country, but I like that strategy.
Yeah,
100%.
I'd love to. Sweet.
Because you really become an investment partner with your investor in that situation, because syndicators typically make the most money when you sell. But if you're actually holding on to the deal longer and longer and longer, and you do those cash out refis, I think that's in the best interest of the investor, because they're getting that refi money back.
Well, they do a return of capital. So all the distributions and everything are return of capital until your principal is paid back 100%, then everything's split 50-50. So it's really, really nice for investors who want to get their principal back, but still stay in deals, right? And get cash flow. And that's how you can be like, hey, you're not going to get any cash flow till year 3, but you're going to get all of your principal back in year 3. And then we're splitting everything 50-50. And then, hey, you're just sitting on passive income and, icing on the cake, and you can take your principal and then go on to another deal or whatever.
Yeah. I mean, that's unique for that particular project, but the key feeling that I would get as an investor from that is I would get the feeling of progress.
Yes.
I would get the feeling of an additional income stream progress. And that feels better than getting a pay raise. And when you're in sales, because it's like you have to work hard for that. I was 100% commission sales, and it's like, what have you done for me lately, is what the boss would always say. But anyway, so that's an example of strategy. And then the partners. And so what I mean by that is, who is that sponsor's relationships with? Who are the relationships that they're bringing to the table? Because as a passive investor, you're leveraging and benefiting from the sponsors network, brokers, lenders, the property managers, the asset managers, the acquisitions team. What's the partner situation like for the sponsor? So, and then do some due diligence. We're actually doing a couple new developments with a new construction company out of Salt Lake. They have $1 billion in development experience. Wow. So it's like, you're not going to get to $1 billion doing the wrong thing.
Correct. Yes.
So
but also don't let that be the reason you just do business with them, right? Still, just because someone has done 20 full cycle deals and this deal is in their wheelhouse, don't let that forgo your due diligence process, right? Get in the habit of always doing it. So that way, when something does come up, in your process, you're able to catch it, as opposed to just being like, oh, they've done this before, here's, X amount.
Exactly. So that's going to cover the sponsor portion. Now we're hopping into the MSA in the area.
Yeah, we'll kind of go through these quick.
Yeah, for sure. And we could chop this up too. So the market KPIs, the sub-market KPIs. Market KPIs is like, I'm looking at Salt Lake City. I want to see the average condo value growth. I want to see the average income growth. I want to see the population growth. I want to see the reduction in crime. I want to see the average population growth, did I say? Anyway, yeah. Oh, job growth. Job growth is probably the most important thing of that. So I'd go to, departmentofnumbers.org and check out how that job growth is. Submarket
job growth and what sector. You don't want one sector to dominate, right? Like a risk that Austin has is they're so heavily reliant on the tech sector. Well, look what's happening to the tech sector right now, layoff after layoff, right? How is that going to affect a market? Are people going to leave that market when they get laid off because, the rent's too high and they need to go somewhere they can afford? Like these little nuanced details are important.
And then let's dive into the neighborhood, because real estate is hyper local, right? So I want to know, what's the poverty for that area compared to the rest of the city? What's the income for that area compared to the rest of the city? I want to know, what's the employment for that area compared to the rest of that city? I want to know, what are the permits and the developments, which I kind of skipped down here. But that's going to, if there's a bunch of permits getting pulled for new developments, then you might have concessions when you're doing your lease up. And what that means is there's a lot more units available for rent. You might have to reduce your rent in order to get the same income. The laws, think of laws with landlord tenant laws as a potential way that impacts the risk. It's a benefit and a drawback. Perfect example, Houston, lots of flood rules. And because of that, some people actually like Houston, because they're players that don't want to be in Houston because of flooding. But if you can navigate the floodplains and you understand how to play with that law, or then it could be a benefit. So understand how the laws impact your local investment. The municipality, how easy is it to do business with them? Are they a pro tenant or a pro landlord area? That's going to impact the risk, not the entire deal. It's not going to make the whole thing go bad. The unit count. What I want you to do is think about what unit counts you like. There's a value to being having more units. For example, if I have a bunch of single family rentals. If one's vacant, I'm completely responsible for the mortgage. I'm zero income. But if I have 100 units that I'm invested into and one unit's vacant, then that's only 99% occupancy. I'm definitely going to be able to pay that mortgage unless we got into some really bad debt situation, which we wouldn't do in the first place.
Right.
And then asset class A, B, C. So typically A class is going to have a more stable tenant, and you're paying a premium for that. So usually the return profile of a class A is going to be lower than a class C. Class C is a lot more work heavy, like property management involvement, but there's potential for higher income. But on the flip side, there's a little more risk with that. Just think of this: Class A tenant typically has $10,000 saved. Class B tenant typically has $2,000 saved. Class C tenant typically has $400 saved. What does that mean? Why do you care? Well, you care because if they lose their job, which one of those tenants are going to be able to float and pay for their rent? Mm-hmm. Most likely Class A. They might have a couple months to be able to pay for their rent. Whereas Class C, it might be a struggle. But and then another thing too, let's hop into number 3. Yep. I want to talk about the unit mix. I didn't put this in here, but typically when you go into a recession, 2 bedrooms and 3 bedrooms are more readily rented because people bunk up together. COVID had the opposite effect. Everybody wanted space. And right. So people are like, I can't live with my parents, or I can't live with this person because I don't want to get them sick. The COVID bubble and all this stuff. So that drove people to get their own spot.
That's a great point. Love that. Yeah. Absolutely.
So hopping into number 3, understand the tax benefits. And what I really mean by that is maybe you can 1031 into it. Maybe you can't 1031 into it. Maybe you can't 1031 out of it. These are questions that you should talk to Jonathan or I about afterwards. The NOI strategy, think of the lever. How are they going to increase the income? How are they going to reduce the operational expenses? Maybe you don't reduce the operational expenses and you focus on solely driving that income. So there's different strategies that you need to be aware of so that you can be comfortable with them.
Totally. Or maybe you're increasing operational expenses, but because of that, the percentage change in the NOI is great enough that it, still increases your NOI and forces the appreciation.
I think that's a way safer way to go about it. If you think about it, my favorite quote when I was in sales is, "You think I'm expensive? Try working with an amateur." And because you want to cut corners and sometimes people, they focus on saving money and they actually really miss out on a big opportunity.
They step over dollars to save pennies.
Exactly. Lending info. This is an opportunity for you as an investor advocate to work with your investor and teach them what type of information is pertinent to that deal. For example, the IO stands for interest only. If I got a 7-year deal and it's new development and 2 years of it is interest only, there's 5 years of they're going to need some new debt for the last 5 years. And to me, that's an unknown on a deal. Doesn't mean that I'm not going to invest, but I just have to be aware of what are the potential rates that the second loan would be.
Especially right now, right? With interest rates continuing to go up, more rate hikes coming. It's very, very important to understand, the different and Colm's example was development, right? In something like, it's already built, like maybe you're buying a Class A from a developer, right? And you're on a 10-year fixed rate. Okay, well, now I don't really need to worry about any kind of, now there could be a refinance in there. So that still could play a role. But, if they get really good debt piece on there, then, that's something you don't have to worry about, right? So.
And this is your opportunity as an investor advocate, investor relations person to coach them, be their source of information, be seen as a trusted advisor, and help them understand this. And then again, help them create this process. It's your excuse to reach back out to them. Just think for every month you don't talk to an investor, you lose 10% decision-making influence. So these are opportunities for you to be a coach for them and to reach out to them to make sure they understand this stuff and make sure they understand the importance of why. Forms D, the only reason I have this is when I deal with New York investors, I always get asked about Ponzi schemes. No other investor location in the country asks me about Ponzi schemes. But for New York investors, they always ask me, I say, hey, check out formsd.com. You'll make sure it's a legit entity and we're a real company. So the last step, and this is going to be 2 minutes, we're going over the deal numbers. So you need to understand how much reserves they have for operational expenses. If things go bad, you need to have an idea of what you feel comfortable with. The fees, you need to understand that there's a cost to operating a facility properly. And it's important for you to pay for the right level. You don't want to be gouged, but you want to make sure that the asset management team has the fees to properly deploy strategies and software and programs to the property to invest your to protect your capital and grow that investment. Also, ask for the underwriting. Garbage in, garbage out here. Okay. I had somebody tell me that my deal, the returns were 2% lower than another investment that they were looking at. And I said, send me the underwriting. So I looked and they sent it to me. I didn't think they would. They sent me the underwriting, and the other person had they had like 10% rent growth for like 4 years. And I was like, hey man, your deal is pretty aggressive. And I don't remember the area that it was. I think it was in Charlotte. Your deal is pretty aggressive, whereas our deal is 2% lower returns. And just on this component of the deal, we have 3% rent growth for 5 years.
Yeah.
You have 10% for 4 years. I don't remember the last year. Maybe it was a 4-year deal.
Yeah, and you're only getting 2% more on your return. So think about that.
Ask for the underwriting, understand the vacancy, understand the rent growth. The key thing about the rent growth is it's compounding. That's why the rent growth is so important. Understand understand that if I increase the rent by 1% on a 5-year project, if I increase the rent 1% in year one, I'm actually increasing it 5% down the line. So just understand that it's compounding, and that's why it's especially important for you to not invest in a deal that's too aggressive on the rent growth.
Exactly. To kind of explain that a little further, if you think of a 1% growth, right? 1% of 1,000 is what, $10, right? So then 1% the next year is now 1% of 1,000, $10, right? So that's where that compounding comes in.
And then look at the comps. I was looking at a deal that they were projecting a sell price, and it seemed a little aggressive. Like, it made sense from the underwriting, but when you looked at the historical sales of the area, it just seemed really aggressive. So be annoying as an investor and ask for the CoStar reports, because that's going to get you the rent comps. It's going to get you the population information. It's going to get you the sale information from a third-party unbiased source.
Yep. And
the last thing is sensitivity analysis. Understand how the returns are affected at different lease-up periods, at different occupancy rates, at different cap rates. Understand how your returns are affected based on the reversion cap rate, which is the cap rate at the very end.
Yep. Huge.
Anything else?
This is so incredible. I love it. And I hope you guys are, if you are listening, hopefully we've said so much that you want to go watch this, because I really encourage you to watch it just to see it. And there's all it is bullet points. I'll be 100% honest if you're just listening, but take screenshots, like save this and use this as your process, because this is, like, I promise, if you get in the habit of doing this is investors who do this, have longevity in the industry as passive investors, if that's how they want to stay. And this is why investors will continue to invest with the same Same sponsor, like they won't deviate from sponsors because they've gone through this process with a sponsor. They've passed this and they've done deals and they now trust this sponsor. And this is how you get that trust, is by going through this, being that annoying investor, and them accepting that you're going to be that, go through this due diligence process, and they have all the answers and they allow the answers. If they won't allow you to do some of this stuff, like dive into their underwriting, that is a huge red flag. If they won't send you their underwriting model, I promise you there is no underwriting model that's a secret model that with a secret formula. I promise you that does not exist. So if they try to tell you they have some proprietary underwriting model for a multifamily investment, I promise you they don't.
And ask for a PDF of it. Say, okay, I don't need your Excel spreadsheet. Just send me screenshots.
Nice. Yep.
And so so much more could be said about this. Maybe there's no CoStar report. Maybe there's a Val Bridge. There is a basis of evaluation. They have property assessment individuals that go out there, ask for those reports. If they're not even doing those reports, then where are they getting their information from? And are they being biased?
Yep. Yep.
So
1,000%. Dude, this has been incredible. Thank you. Super, super in depth. I'm very grateful. I know the listeners are going to be very grateful. A lot of value here. Okay. So we do have 5 questions that we end everything on. So is there anything else you want to add, or should we jump to the final 5?
Just reach out to Jonathan or I if you have more specifics on those bullet points, because this is very high level, but you are doing yourself and your family a disservice if you don't have a process like this, because it's the consistency in your decisions that allow you to grow over time. It's a compounding effect.
1,000%. Couldn't have said that better myself. Awesome. Okay, let's jump to the final 5 here. First question: best advice you've gotten from a mentor?
Version 1's better than version none. Just get out there and do it, because action creates clarity.
1,000%. What is it about your career that makes you feel like you're fulfilling your why?
So I only had this in the last year or so. So I was born with some health issues, and I really need to serve my community. And my community are people that have had similar health issues to me. So I'm creating a mission-based investment group where a slice of the profits go back to paying for therapy for individuals that have had similar heart operations to myself. That's my why. That's my motivation. And there's an incredible fire behind that, and I will not be stopped. I want to make sure I want to donate $10 million at least to paying for therapy for people that have had open heart surgeries, because it's screwed up so many relationships of mine and my family's, just being really impulsive, like thinking I'm going to die every night because of my heart problems and stuff like that. It's a very personal thing. And I think connecting your why to something personal, and it doesn't have to be altruistic. Like mine stems from a place of gratitude. It's like, I try not to cry when I go see my cardiologist. It's like, how do I thank, the Sutter General Hospital group? Then that's how I really want to thank them. And I just wake up like pissed off for greatness. Like there's no other way to say it. Like I just wake up. I really feel like if you can find something that you remove the money, you still want to do it, that's probably your why.
1,000%. Gosh, I could not have said that any better. Thank you for sharing that. That's awesome. Favorite non-real estate or investment related book?
Well, right now I'm in the Brothers Karamazov. Actually, my favorite non, I have 2. So one is by the lady that wrote Eat, Pray, Love, which my gosh, I have to look it up. Not doing her justice right now. I think it's called Think Big. I have to look. I read it like a year or 2 ago. Let me just say The Conquest of New Spain. Okay. So The Conquest of New Spain's fascinating because it is a firsthand account written about 70 years after, or 50 years after they landed on the Yucatan Peninsula and worked their way up into the Mexican capital. And it's a firsthand account from a conquistador describing the relationships and just how clever Hernan Cortez was, and and everybody thinks, oh, the conquistadors conquered the Mexicans. No, there was like 300 of them and 20,000 people from Tabasco that were indigenous that were fighting back the oppressive Mexicans. And it's a 432-page book, and it's written in like grandpa talk. Like the whole thing's very dialogue. And I wish it went through more detail, but I think that was the most captivating book I've read in the last 3 years, The Conquest of New Spain.
Interesting. I'm gonna have to put that one on the list. Love that. I love the sort of outside the box answers to that question. If you could have any superpower, what would it be?
So the book's called Big Magic. If I could have any superpower, I think I'd just go back in time. Like I've said some stuff from the heart that was taken the wrong way. And I would go back in time and not say those things.
I love it. That's awesome.
It's like a genuine thing that's just not received well because you weren't reading the audience.
Totally. Yeah, we all have that, right? Where like it sounds so good in your head, and then as soon as it comes out, you're like, actually, that was not correct.
Yeah.
Cool. What's the best way for people to get a hold of you and learn more?
Just email me, Colm at tgaip.com, and simple. COLM at tgaip.com.
Awesome. We'll link that in the show notes, make it super easy. Colm, thank you again for your time. This was absolutely incredible.
Heck yeah, man. I'll see you in Salt Lake. Well, I'm going to reach out and ask for some recommendations for your city.
Sweet. Look forward to seeing you.
All right.
Thank you again for tuning in. Who do you know that wants more cash flow? Share this episode with them so you can grow your cash flow together. If you enjoyed the show, make sure you're subscribed on your platform of choice so you never miss a new episode. Go to CataniCapitalGroup.com to learn more.